what's going on? In this video, we're going to break down the difference between a mutual fund, an index fund, and an ETF. And we're going to break down which one is best for you. There can be a lot of confusion with these three types of investments because they're so similar in nature, but they also have very different characteristics. I'm going to break down also the pros and cons of each one. Now, let me tell you about a quick story about a homeless man who lived in Sweden. But before we get into it, hit the subscribe button to get more content just like this, to get more fabulous, wonderful, informative, financial topics every single week. There was a guy, like I said, who lived in Sweden. His name was Kurt Degerman. If you read about him in the newspaper, you can get the full story. But essentially, he died at the age of 60. He was a homeless man who had an astounding $1.4 million at the end of his death, who he left it all to his cousin. And the only reason why is because his cousin would see him periodically right before he died and would talk to him, have conversations with him, and catch up with him. He left his family not 1 cent, even though the family tried to sue him, the cousin, because they did not get any of the money. They ended up settling it outside of court. Nonetheless, this guy would recycle scrap metals and also recyclable cans in exchange for dollars and put this money into the stock market. And the way he did this was he never bought a car. He would always see him with a bicycle because he didn't want to spend money on a car. He never rented a house. He never bought a house. He never rented an apartment. And the reason why is because he didn't want to spend the money on that. Now, that is rather extreme, I must say. I mean, for him not to have wanted to rent out a car or rent out a house or an apartment, and he actually liked living on the streets as a homeless man. That's prerogative. Another thing that he did, which was genius, was that he would go to the public library, which is free, and read the newspaper every single day because he didn't want to pay for the newspaper. So he would read the financial columns diligently, and he figured out how to be an expert at picking stocks. Now, think about that. He was able to use a free newspaper at the public library, and he started to invest his money every single week into the stock market. Now, he was able to have $1.4 million at the time of his death. Now, what is the moral of the story here? The moral of the story is, if a guy who's collecting scrap metal and recyclable cans became a millionaire who was homeless, then you can do this too. So before we get into it, we're going to break down a few key concepts that I think will help you understand the trajectory of this video. So we've got to break down what a mutual is and what a fund is to understand what a mutual fund is. So let's get right into it. There are three key components to a mutual fund. But before that, we have to break down what a mutual fund is. So let's break down the term mutual. So many people believe that the first mutual fund started way before the 19th century. There were a lot of people who were putting together money to have a common goal to invest in certain vehicles. But the first official mutual fund started in 1924, called the Massachusetts Index Fund. So we've had mutual funds over 100 years. So what is mutual? So a mutual is something that, let's say, it is held in common by two or more people. So let's say if you share a bank account with two or more people, that's a mutual bank account. Or let's say you hop in a swimming pool with two or more people, that swimming pool is a mutual swimming pool. So that's what mutual is. It's held in common by two or more people. Now let's break down what a fund is. A fund is where you have a collection of people whereby they put their money into a place and they have the common goal of investing this money into certain investment vehicles, which is called a fund. So now we understand what a fund is. We have to break down what an investment fund is. So what is an investment fund? Well, an investment fund is similar to a fund. Well, it's pretty much the same thing. So you're going to take your money alongside other investors. So both of you all, or hundreds of you all, will put your money into a bank account. And this bank account will allow you to invest this money into other investment vehicles. Now, what is the benefit of doing this? Well, you're able to have lower costs and lower risk by investing your money with other investors. And also, it's better to do it this way than to do it by yourself as an individual, because you're going to incur more costs and you got to dedicate more time to it. So this is the difference between a mutual and a fund, and then you have investment fund. So number one, it's convenience. What makes a mutual fund convenient? Well, it allows you the opportunity to invest your money with other investors, and you don't have to worry about it, right? You can work your job. If you're a doctor, a lawyer, an entrepreneur, you don't have to worry about watching over your money that diligently, or picking stocks, or figuring out which investment vehicles are better than the other, right? All you have to do is invest your money inside a fund, and the fund does all the work, which is why it's very convenient. Now, another thing about mutual funds is that you got to have a manager that's going to manage the fund, right? Because the fund itself can't just sit in the bank account, so you got to have somebody managing the fund. So after all these people pull their money into a bank account, you got to have somebody that's smart, that's an expert at allocating money. Now, there's been a lot of debate on whether or not mutual funds have had great returns, better than the standard S&P funds. Now, we don't really know. What they say is that the answer is yes. Some people say no, but nonetheless, you got to have somebody managing this fund, because you don't want to do it, which is what makes it convenient for you to invest your money in the fund. So yes, this person that's managing this fund is probably some super highly educated professional who's good at managing money. Now, what is the con to hiring a professional money manager? Well, typically they charge 1 to 2% per year on the total fund amount, regardless if the fund makes money or not. So if the fund goes low, if the fund goes high, that money manager is going to take his 1 to 2%. One of the benefits of having a mutual fund is what they call economies of scale. Now, what does this mean? So let's break it down. So you can have this fund, and the fund goes out there and is being managed by the money manager, right? Though the money manager has all this money in a bank account, millions, sometimes billions of dollars, and he's going out there to look at which investments to put the money into. He has stocks, he has bonds, he has short-term debt, long-term debt, you name it. Now, once that investment manager decides to put his money, let's say, into stocks, he will get a discount because he's going to buy so many of these stocks, right? He's going to get what they call a volume discount. It's similar to going to a Costco. If you go to Costco and you want to buy toilet paper, you can probably buy, 50 rolls of toilet paper for $5, versus you going to a local convenience store, you're going to buy 1 roll of toilet paper for $1. So you get a better discount by buying wholesale. That's the same thing was happening in this situation with stocks. They're getting a better discount because they're buying so many of them, so they're getting a wholesale discount. Not only that, once they are invested into a stock or a bond, let's say they want to buy or sell these large quantities of money that they have into these investments, they get a discount on the brokerage fees. So the brokerage fees can range. So they won't pay a higher brokerage fees, they'll pay a lower brokerage fees because they have so much money invested in the fund. Now, how does this help you out? Because if you're an individual stock investor, if you're going to go out there and buy or purchase a stock on your own, you're going to pay a higher brokerage fee, right? You're not going to pay as low a brokerage fee investing with a mutual fund. You're going to pay a higher transaction fee investing in the fund. That's just what it is. Number 2, diversification. This is a great benefit to holding a mutual fund. Now, a mutual fund says, look, we're going to take this pool of money that we have inside this fund, and we're not going to buy one stock, right? We're going to buy over 90 different stocks, right? So that's what a mutual fund is. It goes out there and it invests your money into all these different stocks. Sometimes they invest in bonds, and they'll buy multiple different bonds. Sometimes they invest in different types of debt. They'll invest in different types of debt. So how is this beneficial to you? Because your money is not being placed in one basket. As they say, you're not supposed to put all your money or all your eggs in one basket, right? You have to, so by spreading out your money into all these different baskets, it reduces your risk. Now how does this reduce your risk? Well, let's say if you on your own, you go out there and buy a stock, one stock. You put a dollar amount into this one stock. And let's say that one stock goes down 50%. You've lost 50% of the money you've invested in that stock, right? But let's say you invested your money into a fund who have put a smaller percentage of money of the funds into that one stock. And let's say that stock goes down in value, but another bond goes up in value. You've reduced your risk because your money that you've invested, it didn't go down by that much, right? And vice versa. The bond may go higher, the stocks may increase in value, right? So you're able to reduce your risk because certain investments go down, certain investments go up, and you have your money in both investments. So this is how you can reduce your risk. A second thing with this is that the investment strategy that the fund manager puts in place, it's hard to replicate on your own. So you don't know the types of strategies to put in place on your own. Let's say if you were to invest your money into like 4 stocks, 3 bonds, and you trying to come up with your own creative way of trying to beat the market. That's a lot of work, number one. And then number two, it's going to be difficult to do that if you didn't study the market, if you didn't research how to do it, if you didn't go to school for it or even study it, right? You got to study for long periods of time to understand how to do that. Another benefit to a mutual fund is that it's highly liquid. What does this mean? It means that, let's say you wake up on a Thursday morning and you're like, you know what? I want to get my money from my mutual fund. I want to cash out because I had an unexpected death in the family, or I have a health scare, or I want to buy a house, or you want to just use your money for whatever you want to use your money for. You can go log into your app, sell your stake, and that money can be deposited in your bank account right away, which is similar from other types of investments. Let's say you have a piece of real estate. You just can't go out there and do that. You got to put it on the market, got to wait for the right offer. That may take 2-3 months, right? So real estate is liquid, but not as liquid as mutual funds. Another key component to mutual funds is that you have dividend investments. So what does this mean? It means that typically some mutual funds pay a dividend out every quarter, meaning that, so if you're invested into a mutual fund that have done well, they'll pay you a portion of the profits that they've done. Now, they'll give you a dollar percentage at the end of each quarter. With this money, you can reinvest that money back into the mutual fund. So it will increase the amount of shares you have with absolutely no cost, right? So you don't have to worry about spending more money by reinvesting the dividend profit back into the stock, which is the benefit to having a mutual fund. So let's transition here. Let's talk about index funds and how index funds are different from mutual funds. Jack Bogle in the 1970s decided to start an index fund because he got tired of these mutual fund managers charging a lot of fees on their funds. Jack Bogle created the first index fund in the 1970s. So an index fund is essentially a mutual fund. The way in which they operate are differently though. The way in which they operate is a bit different. The mutual fund goes out there and selects the types of stocks and bonds and debts it would like to buy to create a strategy that they think is best for the fund. An index fund is pegged to the S&P, the top 500 companies in the country, and it invests in all 500 of these companies. And so if Apple stock goes up, your stock is going up. If Facebook is going up, your stock is going up. If real estate is going down, your real estate is going down. So this is the benefit of investing in an index fund. Index funds are passively managed. It means that once they've invested their money into the S&P, they're not going to be buying and selling these shares. They're not going to do that. They're going to keep the money in there and they're just going to let it sit. Also, they do have dividends reinvestments, meaning that once you get dividends from these stocks, you can put the money back into the S&P. The difference with mutual funds is that it's actively managed because these managers are going out there trying to figure out which stocks are good, which stocks are bad. So they're doing a lot of buying and selling in that year. So they'll buy and sell, let's say 6-7 times in that 1 year. While an index fund never does that. They buy once and they keep the money in there. Another benefit to an index fund is that once you look at the stock market and you see that the stock is doing well, you know that your stock is doing well. If you see that the stock market is doing bad, you know that your stocks are doing bad. So it's a direct representative of the S&P 500. So when Trump came out with these tariffs, the entire S&P dipped. Everybody's portfolios dipped, right? Because if you had an index fund and it's pegged to the S&P, your portfolio dipped. And lastly, ETFs. An ETF is similar to a mutual fund or index fund. It's pegged to the S&P 500, similar to an index fund. The difference between an ETF and a mutual fund is that the ETF you can trade midday. Okay, if you want to buy and sell midday, you can do that with an ETF. Typically with index funds or mutual funds, your trade doesn't happen until the end of the day. Nonetheless, this is the difference between index funds, mutual funds, and ETFs. In my opinion, I think the best one to go for is the index fund. The index fund is by far the best. Right now, I'm with Vanguard. I think it's the best index fund to go with. Jack Bogle did his thing. You have low transaction costs, low fees, and also a lot of the ETFs and indexes that's in Vanguard, there's no brokerage fee. So I'm not paying to buy and sell stocks inside that particular fund, right? So they have a lot of different funds. You can pick which one you like. I'm with VTI. I think it's really good. I think it's great. Made some money doing it, and I invest every single week. I think it's a fantastic thing. I think mutual funds, the fees are just a little bit too high. So, it's not really the best. So go with the index fund. I think you will do well that way. And the goal is to just keep your money in that index fund and to never sell. Because if you sell it, it's not smart to do, because you can't panic if the stock market goes low. You got to keep buying even when the stock market is low, because that's how you're going to make the greatest upside, right? Don't panic. Keep that money in there for 30 years and you'll become a millionaire. And on that note, peace and love. Take care.